Good morning and welcome to Real Disruption, number 2. My name is Steve Weichel, and on behalf of the Alumni Association of the MIT Center for Real Estate, I'd like to welcome you to all to what I'm sure will be an interesting, informative, and provocative discussion about crowdfunding. While you're getting settled, I'll cover a few of the housekeeping details for those of you who haven't been here before. Restrooms are out this door and down the hall. And also, if you could please turn off all of your ringers so that we don't interrupt any of the speakers today, that would be great. Before we start the program, I'd like to thank a number of people who helped organize and promote this event. Our promotional partners, the Urban Land Institute, ULI Boston, Sarah Barnett, Michelle Landers, and Ileana Tauscher. Thank you for helping us, as always. Also, REFA, the Real Estate Finance Association, Adrian Malley and her great staff. Thanks, Adrian. And so we'd like to extend a welcome to all ULI and REFA members who are joining us either again or for the first time. Our media partner, The Real Reporter, publisher Michael Walsh is a longtime partner. Without him, while we're on the topic of real disruption, Real Reporter is an award-winning example of an alternative, innovative business models that are responding to the disruption that's going on in the media business. So, Mike, as always, we appreciate your being here and helping us. I'd also like to thank our host of Atlantic Wharf, Boston Properties, for making this terrific space available to us for the events that we do. And lastly, I'd like to thank my colleagues from the AACRE and MIT who helped organize the event: Mike Tilford, Dan Pollard, Moana Benton, Greg Batchelor, the AACRE co-presidents, Mike Domenico and Sam Reich, who are here today, and all of the AACRE board members who really work tirelessly throughout the year on behalf of the 900+ members, alums that we have from the real estate program at MIT, located all over the world. Also, I might add today that we are streaming around the world for the first time through our new platform called MIT CRE. That's SEECRE. Nice. I'd like to make a comment about this event. The Real Disruption grew out of a conversation that Mike Tilford and I had really less than a year ago. There was a lot of buzz going on around crowdfunding, and we researched that topic further, but discovered that there are dozens of really fantastic, interesting new technologies that are being developed that will have an impact on the commercial real estate business. So we created Real Disruption. This is the second of a series of breakfast conferences that will present these new disruptive technologies in an interesting format, present them to the entire New England commercial real estate, and really East Coast New England and New England real estate community. At our first disruption in May, those of you who were here, and it was a big event, we focused on technology that was impacting the various steps in the commercial leasing process. But we are now excited to be taking a look at real estate crowdfunding, which we've all read about and heard about, and we're excited to be looking at that. And we're pleased to welcome panelists who each provide a very interesting perspective on the conversation, rather than a panel of all crowdfunding platforms. We elected to have a conversation, a broader conversation, to understand who's impacted around the table when it comes to crowdfunding, including what the impacts are on the various parties will be in real estate transaction, the regulatory issues, and what the future holds. So we'll begin with some comments from Bonnie Burgett, and Bonnie will set the framework for the discussion, give us an overview of crowdfunding. Bonnie is a founder of a real estate investment firm called Sourced Capital, and they are raising capital for deals that have been analyzed and vetted using their complex proprietary algorithms. They'll apply sophisticated analytics to evaluate the properties on a risk-adjusted basis and make informed real estate investments. She's also the co-author of a paper that she wrote at MIT when she was at MIT called Democratizing Commercial Real Estate Investing: The Impact of the Jobs Act and Crowdfunding on the Commercial Real Estate Market. She'll explain all that. in a moment. And she continues to monitor the nascent real estate crowdfunding industry, and she'll share her thoughts with you. And then I'll come back and introduce the panelists and the moderator, and we'll open up the discussion. So with that, Bonnie, I'll turn it over to you. Thank you very much.
Okay, so as Steve mentioned, I'm going to give kind of an overview and make sure that we're all kind of on the same page in terms of the securities law and I would say recent, although the Jobs Act was passed a few years ago, but still in the process of unfolding. So crowdfunding, as probably most people in the room are familiar with, is the idea of, instead of taking large chunks of money from just a few investors, having multiple investors at a lower rate or lower minimum investment. And it kind of is born out of the idea of crowdsourcing and microfinance, concepts that have been around for years. So in studying this, we see the CRE market is perfect for disruption, hence the title of the panel. An SEC paper in 2012 cited that 27% of Reg D offerings made in real estate used a third-party intermediary and had the highest fees in all the financial markets between hedge funds and other private offerings. At the same time, Kickstarter and crowdfunding websites were taking off, and we see that in other industries, in peer-to-peer lending, which I'll talk about a little further into the discussion. And with the passage of the Jobs Act, we see the perfect timing for this to apply to commercial real estate, which is occurring as every day a new real estate crowdfunding platform pops up. So there's multiple types of crowdfunding, and probably the most well-known are the donation, reward, and pre-sale. Kicks and Indiegogo are well-known names, in the industry, and these are actually outside the purview of the securities legislation. So prior to the Jobs Act, they were able to take off and have really enjoyed a lot of success. Next, you have peer-to-peer lending. Prosper and Lending Club are two other platforms that have really taken off as well. You're seeing hedge funds start to invest on these platforms, in fact, which I think is a really interesting indicator for the CRE market. And Kiva is one that's been around for a long time. It's more of a social component, which is pretty important to the peer-to-peer lending and the whole concept of crowdfunding. And finally, to the equity crowdsourcing or crowdfunding, which is going to be kind of our main topic today. With the passage of the Jobs Act, which we'll get into further, you're now allowed to solicit, and we've seen a lot of sites pop up focused on early stage ventures, seed investment, and the like. So this just kind of goes over the huge growth that is occurring in the crowdfunding space. Kickstarter launched in 2009, and the term crowdfunding actually was first used in 2007. So going from a brand new, word basically to a few years later in 2011, the SEC considering it a very important topic, in which they ended up passing the Jobs Act. The Jobs Act was passed in April of 2012, but really, as I'll get into further, you can't actually act on most of the titles that were passed in that law. So it's a 7-title act, and we're going to focus mainly on titles 2, 3, and 4 as it pertains to commercial real estate. Title 2, lifting the ban on general solicitation, is the only one to date that you can actually act on. But Mary Jo White has made it a priority for 2014 for this to implement the rest of the crowdfunding legislation within this. The SEC is really grappling with how to allow unaccredited investors to invest and balance the risk and the fraud and investor protection with stimulating business growth and raising capital. And by the way, I just realized the Jobs Act stands for Jumpstart Our Business Startup Act. Very important. So the 33 Act of the Securities Law basically allows for several exemptions if you're not going to go through a full IPO. And I would say that the majority of the people in this room, if you're out raising money for your real estate deal or whatever, you're using Reg D 506C, or B, I'm sorry. And that is going out to accredited investors, a private placement, unlimited raise amount. And you basically just, I'm sure a lot of people have seen it, you sign your name saying you're accredited. And accredited means that you're either an actual person making $200,000 a year and have made that in the previous years, or a couple that makes $300,000 and has made that in the previous years, or has a net worth of $1 million, not including your primary residence. It also applies to businesses where all the owners are accredited, trusts of $5 million in assets and above. Reg A is a very unused law, mainly because you have to go register with state by state. We'll discuss further there. Fundrise is another crowdfunding platform that's enjoyed a lot of success and has actually issued a couple Reg A offerings. And this allows you to go to state residents and offer to unaccredited investors. So the Jobs Act introduced a couple expansions to the 80-year-old law, and that's Reg D 506C, Reg A Plus, and Title III. And Title III is basically what a lot of people think of when they think of the Jobs Act and discuss crowdfunding. It's called the crowdfunding title, and this allows a company to go out and raise up to $1 million per 12 months, every 12 months, and solicit to unaccredited investors. One of the issues that the SEC is dealing with is that it limits how much each investor can invest per year, and that's meant to provide investor protection. But how to implement that is easier said than done. So next, Reg A. So Reg A Plus takes the $5 million limit that already existed under the 33 Act and ups it to $50 million. But most importantly, it's removing the blue sky laws and allowing this to really be a viable option for commercial real estate and companies looking to raise funds without going through the full initial public offering. So Reg D 506C is really what everyone out there right now that's using equity crowdfunding is operating under. The ban on general solicitation that applied in the existing securities law was lifted in September of 2013. It now allows you to go out and solicit, but you can only take accredited investors, and the onus is on the issuer to vet them. And that means taking reasonable steps to make sure that they actually are accredited investors. And that's, you're looking at tax returns, credit reports, statements from, of their assets. But most people are also accepting letters from CPAs, investment advisors, and attorneys. So that's basically dealing with the securities law, and now you're looking at multiple business models on how to implement and go out on the internet and raise the funds. A lot of parties are using a broker-dealer, which under Title III, you're actually required to use that if you're going to charge a fee up front. And this allows for the BD to complete compliance, add some level of investor protection. What we're seeing right now is there's a lot of the groups out there are charging a 3 to 6% placement fee. And similar to that, these kind of overlap a little bit. It's online syndicates, sometimes they'll charge an upfront fee and be aligned with a broker-dealer, sometimes not, form their own sub-LLC, and go out and issue shares within that sub-LLC of the investment at a lower minimum investment. So a lot of groups, which I think we're going to get to later on when we talk on the panel, are not interested in dealing with 100 investors. So instead you're issuing 1K1 to the LLC and then letting the online syndicate manage the investors. There's also groups doing vertical integration and working with tech providers and white label platforms to just do it themselves. Pluses and minuses to that as well. You're now dealing with your own investor relations, but there's a lower cost. And finally, there were a few groups doing some marketing and lead generation. Surprisingly, the two that I know of doing that have shut down, and I think that kind of speaks to investors wanting their deals to be somewhat vetted through the online platform. So in the last year and a half, we've seen an amazing growth in the crowdfunding platforms. About a year and a half ago, there were probably 2 to 3. A year ago, roughly 20, and now we're just hovering above 50. There's a very definite separation between those that are looking more towards commercial and institutional level versus groups that are focused on a lot of single-family fix and flips that I'll speak to a little later. And recently, we've seen a couple larger institutional groups jump in, as well as some tech providers and secondary trading platforms. So as I mentioned, there is quite a bit of groups that are focused on the single-family rehab loans. Basically, they're seeing that simple sells. Retail investors understand residential. They understand flipping a house. It's an easy, fast return. And a lot of the loans that are also being issued are borrower-dependent loans versus secured first mortgages. Along the same lines, there's a huge push to sell yield, which is has to do with the market that we're in now, but a lot of, the big buzzword is cash on cash to the retail investor. Most of the sites right now are advertising annual returns between 7 and 12%, and I would say the majority of IRR is advertised. Obviously, it runs the gamut, but 12 to 17%. So we've seen raises as high as 1.5 million, which I'll show an example deal later on. Average raises per crowdfunding platform, you're looking at 250 to 500 for the most part. And I think that as time goes on, it's slowly moving up. But going back to the concept of crowdfunding in general, the average minimum buy-in is pretty low. So if you're thinking, a lot of private equity funds are, ask for $250,000 minimum. The crowdfunding platforms, you're looking at $5,000 as a minimum. So here's an example deal that just recently came out on another platform, and I felt like it was a very typical deal that you'll see in the industry. And the sponsor had already closed the deal, and they reserved a portion to syndicate out through a broker-dealer. And again, 8% preferred return, 13% IRR. So Realty Mogul has done a very well-known deal that was out in the press for $1.5 million for a 15% equity stake in the Hard Rock Hotel in Palm Springs. And what was really advertised to investors was sort of the perks that went along with being a hotel owner. So really why crowdfunding matters, I think that pretty much everyone that's sitting on the panel today would agree that using the internet to raise capital for real estate or for anything is really not going away, right? And a lot of people see it as a way to add, efficiency, transparency, increased access to deals and investors. So part of the paper that I wrote was looking at what a potential size of the market was. I actually focused on the market below $5 million in total asset value. which according to CoStar is about 77% of the overall commercial real estate market. And just even looking at a 1% market penetration, using two different ways to analyze this and come up with the numbers, you're really looking at a $2 billion to $5 or $6 billion potential market for crowdfunding. So where do we see the future going? I think that's what the panel, we're going to really address that as to why everyone up here is interested in it, what we see happening. This is kind of a take on a blog that was recently written by a founder of EquityNet, and he predicted that this year there'll be up to $1 billion in equity crowdfunding. That's including commercial real estate, but as well as seed investment and venture investments. And that large institutions will continue to explore the concept. I think if you look back to Prosper and Lending Club and how hedge funds are moving into that industry and actually even edging out the retail lenders on the peer-to-peer lending sites, that's definitely going to occur in the commercial real estate crowdfunding industry. Hopefully in 2014, the SEC will release the rules and regulations for Title III, as well as the Reg A Plus, and we'll see how that plays out. And I think 2015 is really the year to see. I mean, that's a full year with those laws in place to see how it will all shake out. And I think most people that are knowledgeable in the current CRE crowdfunding space feel like at some point there's going to be a shakeout and consolidation, just given the fact that we're above 50 platforms at this point, and daily you'll see new ones enter and existing ones drop out. And I think that one of the topics that we're going to discuss on the panel is, what happens when a deal goes bad, the risks, and where we see all this moving forward. So with that, I will turn it back.
Great. Thank you, Bonnie.
Terrific. So that gives us an overview of the conversation. It's an interesting, complex, much more complicated topic, but I hope that sets the stage for the discussion. Let me introduce the panelists. We are very pleased to welcome panelists from a couple of different perspectives in the industry. In no particular order, or maybe. Adam Hooper is here with us. Adam is the co-founder and CEO of RealCrowd, which is a Y Combinator and venture-backed online real estate investing platform where accredited investors can co-invest in specific institutional quality assets with best-in-class professionals. RealCrowd is built on the founders' collective $3 billion of institutional quality and underwriting and transaction experience over 20 years. And also, they're based in Silicon Valley, so they have access to some really incredible talent out there. The second, David Stifter, is Chief Compliance Officer at Colony Realty Partners. Hi, David. Colony is a privately held real estate investment company that acquires and manages commercial real estate properties on behalf of many of the world's leading institutional investors. In his role, David is responsible for, amongst other things, evaluating the suitability and viability of various crowdfunding platforms for large-scale institutional investing. So he'll have an interesting perspective on that. Since 2005, Colony has acquired a portfolio of more than 175 individual investments at a cost of over $4.5 billion in 22 major U.S. metro areas. So they're, for those of you who don't know, they're big. Arvind Shari is a co-founder and managing principal of Atlas Real Estate Partners in New York. Hi, Arvind. An investment firm that has applied their unique combination of real estate and capital expertise to acquire assets at discount to replacement costs and comparable sales. Atlas has closed on 27 transactions in the past 4 years and currently has a portfolio valued at over $450 million with a focus, again, on institutional quality and value-add assets in target markets throughout the U.S. And notably, importantly, 3 recent acquisitions by Atlas involve crowdfunding. So we'll hear Arvind's perspective on that. So I'd like to welcome the panelists. And moderating today is Todd McGrath, the president of Advisor RE. Many of you actually know Todd. He's I'm sorry, and Bonnie's joining us too. I'm so sorry. See, I should have looked at the name tags. Todd, many of you know Todd. He's been a veteran of the industry, has been at Meredith and Grew, McCall and Almy, Winthrop. He currently advises globally, nationally on a variety of topics: strategy, valuation, market analytics, restructurings, blah, blah, blah. Okay, no, I'm not done yet. I'm not done yet. More importantly, he was the recent executive director of the MIT Center for Real Estate. He's on the faculty at MIT, teaches a great course, and is hosting Alumni Back to School in New York next month.
Yes.
Okay. So if you'd like information on that, please see us. So I will now turn it over to Todd. Thank you very much.
All right. First, I'd like to start by thanking Bonnie. That was an excellent presentation. It gives us a great framework to start thinking about crowdfunding. And we saw in Bonnie's slides things like house flips and investing in a retail strip center and the Hard Rock Hotel. And before we dig in and we get a tour through the Real Crowd site, and we talk to Arvind about some of his investments, I want to start with David. David, Colony Realty Partners is a very well-known real estate investment manager. It's very interesting that you're looking at the crowdfunding space. What is it about, or what's your perspective on this sort of spectrum of disruption, and how do you think you can profit off this? What are you guys really doing as you look at the crowdfunding space?
Yeah, so we're definitely here from the perspective of a very traditional, large real estate investment advisor. And so for us, this is definitely something very new. And part of the issue with crowdfunding is there's a very visceral reaction when people hear the word. They think of house flips and small deals, and so that doesn't necessarily is not necessarily something associated with established real estate investment companies. And so we started looking into this and digging into what actually is going on with crowdfunding. As Bonnie mentioned, there's a very broad variety of firms involved here. And what we found is there's a real spectrum, talking about disruption, there's a spectrum of disruption. And so at the deep end of the pool, so to speak, is the real crowdfunding, which is Title III, which is generally soliciting, so advertising broadly, you can see it on TV and ads, to non-accredited investors, so you have people that could throw up $100 a deal to invest in a piece of real estate. At the shallow end of the pool, which is where our firm we're looking, dipping your toes in the water, is kind of replacing a traditional firm, which is people have already used intermediaries and broker dealers. Like Bonnie says, 27% of deals, think about 27% of all the real estate deals are already using a broker. And what we found is that this is really kind of broker dealer 2.0, where what you're doing is you're taking this traditional model and you're introducing a tech base to it. So you're removing some traditional. Instead of going to JP Morgan and charging a pretty substantial fee, you have an opportunity to use a much more efficient platform, which is the internet, to get a broad audience. And we started thinking about the scale, and Kickstarter's raised $1.3 billion, and that kind of gives you an idea of the scale of what's out there. And in America, I think there's 8 million households that's qualified as accredited. So from our perspective, we're really looking at accredited investors, non-generally solicited, which is kind of what we're already doing. And then as time goes on, we expect that as things become more defined, and it's not just the written rule and it's also the interpretation of it. So we expect that the SEC is going to be a back and forth process where these rules are established, and then the interpretation happens, and that's really where you see people getting more aggressive. Is that they're going to sit back a little bit, they're going to see how the SEC is interpreting these rules, and then you'll see people moving down this spectrum of disruption. So they'll start maybe, some firms start with being more aggressive, some will be less. I think larger firms like ourselves will be less aggressive. But as there's some understanding of what the SEC is looking for, people will be much more comfortable taking on a little more direct approach.
Excellent. Hey, you know what? I'll take a question or two. Or not. All right, so why don't we go with, why don't we have Adam come up? Adam is going to walk us through his site. He's going to hopefully highlight for us what he thinks is important to understand about raising equity capital online, and maybe talk a little bit about his business model and why Real Crowd made the choices they did to, oh, you know what?
That's rule number one of doing live demos is assume they're not going to work. So we don't know if we have connection.
You know what, I look down there.
No internet access. That's not good.
You know what, why don't you get out of it, disconnect and then connect again. Oh, we're right there, yeah.
Let's see, fingers crossed.
Yeah.
There you go. Perfect.
Boy, you people in Silicon Valley really do know this tech
Hey, you
stuff.
know, we make it work.
Sure boast a lot about it.
Perfect. So what I thought we would do is take just a few minutes. I mean, this is all public live stuff, so we'll just kind of touch on it real quick. Keep in mind, though, what we're going to do here today, September 22nd and before last year, might get me in jail or maybe might get Mashia in jail. So this was a major change in the securities regulations from September 23rd of last year that changed, and Bonnie touched on it. The ability to make general solicitations for 80 years wasn't possible. So me standing up here or anybody up here, soliciting an audience they don't have a pre-existing business relationship with was illegal. You couldn't do it. And so that's what changed Title II of the Jobs Act. That's what we're focused on, is making the general solicitations. Some additional requirements do apply. As Bonnie said, only accredited investors can participate. And so the crowdfunding name is typically associated with that Kickstarter, that rewards-based model. We're not truly crowdfunding. What we're doing is we're taking the tried and true method of real estate syndication that's been done for decades. We're wrapping it in a technology layer, we're making it massively efficient. And so it's I think just a step beyond what what David was saying earlier of taking that broker-dealer model and taking that next step of really pushing the boundaries of this general solicitation space. Very new world. Few people are comfortable pushing those boundaries. I think we're getting there. The acceptance is definitely changing. So really quickly, we'll just run through our website, show a live deal here. So we just redesigned the website. Again, hopefully we just launched it last night. Hopefully this all works. So the main things that investors are looking for that we've seen, we focus mostly on high net worth individuals. We are starting to get into smaller hedge funds, private equity shops, family offices, and starting to get some institutional interest too, which is, I think, exciting for us. I don't think we had ever anticipated the institutional interest would come this fast. With Lending Club and Prosper and some of these other peer-to-peer lending sites, I think Prosper, it took them 8 years to do their first $1 billion of originations. All of a sudden, institutions started getting involved. It took them 8 months to do their second $1 billion. So I think this is going to ramp a lot quicker in the peer-to-peer lending space. Obviously, real estate is a much more known quantity than unsecured personal debt. So I think we'll see institutions getting involved quicker, and that's only just going to escalate and accelerate the growth. So basic things that we see high net worth individuals are looking for, as they would in any syndication, is exactly as Bonnie said, it's the cash on cash, it's yield. For a lot of folks, this might be the first time that they've ever been able to access real estate. And so they're looking at this asset class as a way to get to that current cash flow, get that diversification where, before, maybe if you knew somebody that knew somebody, you could get into a deal and you have to write a check for $500,000 or $250,000. Most of the minimums on our site are around $25,000, varying from $10,000 to $50,000 typically. So it gives people the opportunity to get into this asset class with best-in-class real estate operators that they would never otherwise have the ability to get in front of and build those relationships with. So cash-on-cash yield, I'd say there's definitely a preference towards a shorter term as well. This being the first time a lot of people have been able to access this asset class. If they're used to the public markets, equity markets, where you can get out when you push the sell button, tying your money up for 5 to 7 years for a lot of people is still a fairly new concept. It's a foreign concept for people. So shorter term, cash on cash, not too much focus on multiples or IRRs, typically what we'll see on the institutional side. And so our goal is to make investors feel comfortable with who they're partnering with. We're approaching the space very differently than a lot of the other companies out there, and that we're not acting as principals in the deal. So we're not building a real estate crowdfunding company, but we're looking at the space. We're building a platform that allows other real estate companies to build and do their business better on top of our technology platform. So in the technology world, and this is a little Silicon Valley jargon, there's features and there's products and there's companies and there's platforms. So a feature would be signing documents electronically or making a commitment for how much you want to put into a deal. A product is if you take a couple of those features and you bundle them up. So the ability to make a commitment for how much you want to invest, and then you sign a document electronically, the product. The next step is a company, so you're building a crowdfunding company, which is where I think a lot of the people in the crowdfunding space are focused in building a real estate crowdfunding company. So you're building an operating platform, you're building a real estate company, you're an issuer of securities, you're a sponsor yourself, and then you're using this product to raise the capital. We're taking it kind of a step beyond that and looking at it, how can we build a base technology platform that allows every real estate company in the country to raise the capital through this new method, to use our technology that we're building as a platform, or really build on top of that. So we're looking at it as, how can we give real estate operators the tools to raise capital more efficiently? That's really what we're focused on. So again, basics, this is all public. You can see all this on the website. Overview, we've got a video, marketed nice video. Basic overview on the operator, who they are, what their track record is, contact information, financials. We go through all this, hopefully you can see it all up there. Trying to present the information again in a way that an investor can get comfortable, they can make that decision, they can review all the diligence information, they can feel that connection with the real estate company. I'd say it's probably maybe 70% who the partner is, who are they giving their money to. Do they trust that this person is going to be a good steward of their capital? Do I believe that they're going to do what they say they're going to do, basically? And then it comes down to the actual specifics of the deal. So obviously you've got your financials, you've got maps, you've got information, you've got all your documents, so you can see the full PPM, you can see the financial run. If they're going to upload all their due diligence material, you can do it right there. And then the ability to interact with the real estate company through the platform. So all the questions and answers go through the platform. So it's no longer the very brute force kind of one-on-one approach to syndicating capital. It all happens electronically. It all happens through this portal, basically. And so on the back end, which you'll get, and this is a dummy site that we created. We're not actually buying Disneyland or the Golden Gate Bridge. So this is what we have a private label platform, basically. So what we'll do is we'll go for real estate companies that, if in David's case, if they're not ready to make that leap into general solicitations, we can basically build all the technology that they want, all the technology that we have on the public side, as a private label platform. So you can stay within that, the non-general solicitation space, but you can still benefit from the efficiencies in the technology that we're building. So this is on the back end. What you'll be able to see is how capital is being raised. So this is basic stats, how much is raised, how many investors. You can see some basic stats, how many people are viewing it, how many people are looking at the OMs. And then you'll be able to go in here and you'll be able to drill down. You can see where they're at in the process. So instead of, again, calling Anthony Martin and saying, hey, Anthony, where are we at in the documents? I sent it to you 2 weeks ago. You got to make sure you get it signed. We're closing on Friday. You can come right into here in your dashboard and you can actually see where they're tracking in that process. So, the deal submission, the accreditation part, which Bonnie touched on, the SEC was kind enough to say that you have to take, quote unquote, reasonable steps, which was very kind of them to define that so well. But basically, probably 80% of the investors that we work with, one of the safe harbors per the SEC is they have a third-party letter. So that's a broker-dealer, an RIA, an attorney, or a CPA can fill out a form letter on behalf of that investor saying that third party has taken reasonable steps to verify that they're accredited. If they don't do that, then exactly as Bonnie said, we're collecting tax documents, 1099s, K1s, W2s, or we're collecting statements of net worth, so bank account statements, brokerage statements, credit reports, and then we're actually giving that information to the operator to make that final determination. And
Adam, we have a question from the crowd.
Let's do it.
All right. What's the role of broker-dealers in Real Crowd's platform? Is Real Crowd partnered with a broker-dealer?
We are not. There was an exemption in the Jobs Act to have to register as a broker-dealer for portals. As such, so we're structured to fall under that exemption. We don't handle customer funds. So the three main things to not have to register as a broker-dealer is you can't actually take custody of investor funds. So we don't ever take custody of your dollars. The investor transfers it directly to the operator, to their bank account or escrow. We don't take a commission, so we can't charge a performance-based fee, basically. And we can't be proactively soliciting. So we can't call Anthony Martin and say, hey, Anthony, this is a great deal, you're going to get XYZ return. So there's different lines on that. A lot of groups are aligning with a broker-dealer. Someday maybe we'll go that route. Right now, we feel that we're structured in a way that We don't have to. Again, we're not acting as principals in the deals. We're truly looking at this as a technology platform that allows issuers to raise capital for their deals and interface with those investors directly.
So your platform is relatively passive.
We're a relatively passive guy.
Okay.
Yeah.
And I think that's part of the difference of what different companies are looking at. And I think if you look at smaller companies that are regional companies, I think they have a real advantage also in this, in that they're capable and they're set up to handle large amounts of investors like that. Where Colony Realty Partners, we have a small number of very large investors. Therefore, we're not capable. If we have 100 investors in 5 deals, that's a big job, and that's a lot of infrastructure you have there. So when Bonnie talked about syndication and broker-dealer, I mean, that's if you're a larger company, it may be much more attractive to go with someone who A, is a broker-dealer, just because it's belt and suspenders, you feel very comfortable.
Right.
And B, when they're syndicating, you send out one K1, you send out one set of distributions, and you don't have to worry about the 50 people calling you up every day and talking to your CFO, because he's focused on real estate, he doesn't want to deal with all those retail investors. So I think different companies will see that differently.
Yeah, that's, I think a good point David brings up. Our focus on this and our kind of opinion around the whole method which this form of raising capital can exist is that through this technology that we're building, we can make it more efficient to manage a bigger pool of small investors than what you're currently doing today offline. If we can't truly solve that key issue, if we can't make it no more work for David to manage 50 investors than it is 2 or 3, then we don't think this kind of method of raising capital can ever really thrive. So that's where we're focused on building up that technology platform that makes it so it's not any more work to manage 50 investors or 20 investors than it is 2 or 3. So that's again, I think our core focus is how can we bring enough efficiency to this whole process to where that's no longer an issue.
All right, another question from the crowd. Actually, a couple of them. Who vets what's uploaded to the site, and who verifies audited financials? So we'll go from efficiency to quality.
Sure. So quality. Our focus is on the operating company. So our focus is making sure that we're getting the best operating companies using our tools, and then we give them the platform and the technology to raise capital for their deals. A lot of you guys in this room, and ladies, I mean, you've built your business by knowing what you do. I've been involved in $1 billion of deals, but I'm not an expert in Boston office properties. A lot of you here probably are. So I think for platforms that are putting themselves in an advisory position, you have the fiduciary hat on. And if you have the fiduciary hat on, you better know what you're doing, and you better actually do your diligence all the way down to to appropriate levels. In forming that advisory role in that middle company, which again, I think you get back to forming a real estate crowdfunding company, which is really an operating company that's kind of augmented by this technology. You're adding a lot of operational weight to the model, right? You're replicating all of the diligence that's going on at the asset level. You're replicating the accounting, all the reporting, all the work that the real estate company is doing at the asset level. You have to replicate at the entity level, which we feel just adds unnecessary weight, timing, expense, and ultimately takes out returns from the investors' pockets. So that's where our focus is. We want the best real estate companies in the country using our platform, and then we want to do their job, 20x more efficient.
I got one more question.
Okay.
How do you make money?
We just charge the real estate companies a flat fee. So again, as part of not being a broker-dealer, we can't charge a percentage of performance-based fee. So we just charge a flat fee upfront, not performance-based.
Okay.
So that's, I think it's a much more clean proposition, especially for the investors, right? We don't charge the investors anything. So when you come to our platform, you invest in a property, you're investing directly with that real estate operating company. You're not investing in, Real Crowd 16 LLC. We're investing in 123 Main Street LLC. So it's much, very transparent, zero load for the investors on our platform, which is again, some of the fees that are being charged out there are pretty exorbitant on some of the other platforms. So
and that's a real advantage for Adam's firm in that the more full service ones, not only they want it up front, but they also want a piece of the promote typically. So they're going to take a piece of your promote and they want upfront money. So as far as value to the operator, those direct platforms are efficient.
Yeah, we got an email from one of our investors that they saw a deal on their platform, won't name names, but they liked the deal, right? It was a good deal, it fit their profile, they're excited about it. But then when they actually dug into the returns, 25% of their year one returns were going to fees to the platform, which is pretty extravagant. I mean, that's, even the non-traded REIT space, it kind of gets a bad rap for fees, but I mean, they're only like 14, 15%.
That was extravagant back in the days of the syndications in the 80s.
Yeah.
That's extravagant.
And that was very much the brute force kind of hand-to-hand combat. So this is, to be able to leverage this technology should, in theory, lower that cost of capital. It should make it more efficient. It shouldn't be adding that much weight to it. So that's our humble approach.
Excellent.
Thanks.
Fees are and how they're determined based on size of the company, based on size of
Nope. So it's just, again, a flat fee, regardless of whether you raise $500,000 or you raise $5 million.
same fee.
Same fee. And so our typical deal, I think, average deal is anywhere from kind of $750,000 to $2 million. Average investors coming in for about $75,000. So it's again that catch-22 of this crowdfunding word. The media push is huge, right? The media is behind this crowdfunding thing, but that's very far from what we're doing. We're taking traditional syndication, making it hyper efficient. So
Excellent. Thank you, Adam. That's great.
All right.
Okay, so we've got cards out and about, and I'll also take anyone's hand if they want to raise their hand, because that's probably the most efficient way of efficiency. I'd like now to bring Arvind up, and we just heard some things about having 50 investors in a deal, and maybe a preference for 1K1, and I'd like you to talk about the deals that you've recently done that have included a crowdfunded equity component. Maybe also comment on this issue of having crowdfunded capital and institutional capital in the same deal. So let me get Arvind up here, and we want to go back to your slide. And we're good.
Excellent. Hey, everyone. So as Adam kind of touched on, people are probably asking, a couple questions why we entered into the crowdfunding space, and a little bit more about the actual deals we did. But to kind of take a step back, probably get to understand what we were doing prior to even crowdfunding came online was we were essentially crowdfunding with our own internal network. So, what crowdfunding is basically taking syndications online, and it was kind of perfect timing. So we started the company in 2009, and we decided to go the route of kind of avoiding the private equity and trying to connect directly to our investors. So we started with small teams, quickly built that up, and had we have around 300 individual investors. So during the same time, a couple of years ago, as crowdfunding was coming along, we started taking a very close look at the space. Initially, it was the intrigue of additional investors, access to additional capital that we would never be able to tap. But as we quickly looked into it, was really the technology and making our lives easier, more efficient, that really attracted us most to the space. If you look back, probably even 20 years ago, we talked to some older guys in the industry. We mentioned syndications. They kind of scoff at it, and they say, because when they think about it, it was calling each investor, putting checks in an individual envelope, having to deal with individual meetings, and then nowadays everything is done online. We communicate with hundreds of investors through emails, through websites, and get information out much quicker. So as we started looking into it, crowdfunding was a perfect complement to what we were doing. We wanted to automate everything, have investors, give the investors the ability to get information through logging into an online website, and instead of having to take all those calls, it's all kind of done through the internet. So that was, as we started looking into the space, it was why we actually decided to actually test out a couple crowdfunding deals. And I think the other, third thing that was where we think the industry is going is real estate's still kind of stuck in this old age. It's been a very old school industry. Everybody's very private about what they're doing, and I think in finance in general, everything's moving towards being a little bit more transparent and putting your track record up online. So we believe in the deals we're doing, and so we decided that we want to be very transparent. We want to be first movers in the space where we're going to put our deals online, hold our feet to the fire, and you can actually see what we do. And if our deals do perform, our belief is that it's even going to make our jobs a lot easier to attract capital. After, if you distill it down, we're believers that capital drives our industry, drives our business, and the more capital that we can raise is going to make our jobs easier in order to find better deals and keep our business thriving. So that's kind of what led us to space. And coincidentally, we the first deal that we crowdfunded was with Adam and Real Crowd. Just taking a step back, we'd actually talked to all the crowdfunding sites to try and figure out which site we wanted to go live on. And what really drove our decision was, most of the deals we do are, let's say, they're more institutional deals. So we were very brand conscious too, just thinking about if we're going to put, our name and our deals online, we do not want, a kind of a core plus office deal in DC next to a house flip in Indianapolis. I think that it would confuse, from our investors and our brand, it kind of confuses that somebody's raising $100,000 and doing a $15 million deal. And so as we kind of talked to everybody in the industry, Real Crowd was kind of aligned a little bit more than to what we were trying to accomplish with our our crowdfunding. So we did our first deal was a value add office retail deal in DC, which we did end of last year. You can see the numbers on it, but what we did was we wanted to just kind of test it out. So I think it was maybe around a $4 million raise, and when we talked to Real Crowd, we said, well, why don't you guys just raise 10%? And it was because we didn't really need the capital, but we really wanted to kind of test out the platform, and it worked incredibly well. We were oversubscribed, but I think we capped them, and I think a couple of things just about the deal that made it pretty attractive was had current yield. It was in a market that everybody understood, and I think that if when we were going out before crowdfunding, the way that we got our investors is we promised them, but we showed returns that were current, so that it might be their first time investing in real estate, but after they get their first quarterly distribution, they believe it's a little more real, and then they get their next, and they get a little more comfortable. And so we saw that. I think that we wanted our first deal to be something that we'd be able to distribute right away. So it had current yield, was very well occupied, but there was some additional upside through re-tenanting property. The second deal we also did was Real Crowd again. A little bit. It's also kind of just outside DC. It was a value add office deal, but had a lot of the same aspects as previous deal. It had current yield, but there's probably a little bit more upside in there. Again, we think it was right around 10% that we gave to Real Crowd. And those deals we just did, it was just a first mortgage and an equity, so all the Real Crowd investors came in right alongside our investors. And then the third deal we did with Fundrise, which is a little bit different. It was a little bit more it's a little bit more transitionary deal that we did in Miami. And the other difference was it was actually more of a mezz piece, or actually it's preferred equity, so structured as preferred equity, so we didn't have to do anything with our first mortgage. And it was a little bit lower equity raise for us, or preferred equity raise, and we were kind of testing out their platform with the investors were capped at a 12% return. So I think the common theme that we decided to go towards, just because looking at all the crowdfunding sites, we really wanted to get and interact with the end investors. So it's pretty important to us that if we're going to crowdfund these deals and do all the work that comes along with it, which I can touch on, that we wanted to have relationships with these investors, hopefully for years. So a lot of the other crowdfunding sites we talked to were going to be more of a broker-dealer model, where they were just going to package it up and then come in as 1K1, and we don't really know who the end investors are. Sites that we decided to partner with on the crowdfunding side do allow us, we have direct interaction with these investors. So for future deals, hopefully those investors will be investing, which I think was pretty important, given that we had to do, I think, a little bit more additional legal work, did full PPMs, and just a lot more diligence and that comes around, being a public deal that goes online.
You mentioned that this equity is riding alongside your. Are you offering it at the same terms?
So these were actually, these 3 deals were done in syndications of 30, 40 investors. So the crowdfunding investors were just one of those. So there wasn't true institutional equity. We actually haven't done anything where it's been a private equity fund as majority LP. I think where we've done those deals, but where we've run into issues is that private equity fund traditionally has all the controls. So somebody's coming in is they're not really investing the sponsor day to day, because the private equity fund can usually, if they want to, get the sponsor out of there. So we haven't. We've decided that it's a little bit more difficult to get, because they're really be investing more in like a GP position. So
you're not replacing your investment.
We have not.
See, we have done, I think, 2 deals where they were coming in on the GP side, though. So it can't be done. I think we'll probably launch here soon a deal with another fund that's raising a GP co-invest fund. So you're coming in as an investor in that GP position as a fund model. So they'll go out and deploy that capital with institutional LPs. So it can happen.
How are you able to convince your partners that the capital will be there when it needs to be? That's the market, your lenders, and how your lenders vet these individual investors.
Yeah, that's a really good question. I think that's one of the, if I had to say there's cons in the industry, I think just around legal structuring and potentially not knowing some of these investors personally. But I think the other is timing. And there's a reason that we haven't really needed this money. It's more that we want to be in the space. We're also trying to dip our toe a little bit in the water, but we're also we actually had the money from other investors if we needed it. So whereas I don't think Real Crowd guarantees any sort of equity raise. We kind of give them a target. We had the ability to backfill it. So I think if there was a situation where we were depending on Real Crowd to come in with that money, I think that put us in a little bit more of a difficult position.
I think we found that everyone is doing that approach where you're happy to take the whole deal down yourself. It's not something where you're saying, hey, I want to buy this building, and I'm going to go get money from the crowd and then put it under contract. It's always situations where you have it under contract, and you want to kind of get backfill or just add additional equity. So you're happy to take the whole thing down if the crowd doesn't materialize. Because there's a lot of risk involved. You want to put your reputation at risk because you fail on a deal because hey, the revenue didn't happen. So I think everyone pretty much has the capacity to take it down themselves.
The lenders are able to get their heads around these individual investors, or is that just not an issue at all?
Yeah, we haven't typically won't let any of our investors in our syndications be any more than 15% of the equity, specifically because then the lenders want to do the that was, they're just other investors of ours. They didn't really need to know that the way that we were sourcing those investors was through crowdfunding.
How do you handle the capital call?
It's that's going to be interesting to see another thing in how these investors that come in through crowdfunding handle that. It's the same way that our typical syndications are. So if we have to do a capital call, then we'll go out to the investors. And if they don't fund, then they'll be diluted.
How long is the typical grace period from launch on one of these sites to cash in here?
We've tried to. I think we've probably done it. If we usually have a 30-day due diligence period and 30-day close for day one live. So we'd like to see the money raised by the end of due diligence, which has been successful. So 30 days. I don't know if Adam usually tell people.
Yeah, I think that's accurate. I mean, it can be anywhere from a couple days overnight. I think we launched both beers on like a Friday afternoon. When we came in Monday morning, they were pretty well subscribed. And that's the interesting thing, right? I mean, this is a change from having to pick up the phone and send emails and call people. They're able to consume this information kind of on their own terms. So it's on their iPad, or it's they're laying in bed at night on their their laptop, whatever it is. So it's pretty much 24/7 that these people can access this information now and make those investment decisions on their own terms. So it can happen pretty quickly. It's usually again a couple days, a couple weeks that we usually see it.
How are you guys making that, figuring out if they're going to actually, they might say that they're going to be in, how do you actually figure out when they're going to fund?
Yeah, so we usually,
Microphone.
oh, sure, thank you. Usually, as per any syndication, we'll typically oversubscribe at 15-20%, assuming there's going to be some attrition. One of the nice things is we obviously, we have access to data. We know how many commitments this person has made in the past. We know how many they've completed. We know where they fall out in the process. We know if they're downloading the PPM. We know if they're reviewing. We know how much time they spend reading the PPM. So there's definitely a smarter approach through analytics that we can take. That we can start tracking these behaviors and see where they go. But it's transparency from the real estate company into the investor, and all of a sudden the investors have to be transparent too. So if the next deal that we do with Arvin, if they see an investor come in that's made 10 commitments on deals and they funded one, you're probably not very highly likely that they're going to come through on that one. But if you've got a guy that's made 5 commitments, he's funded all of them, you're probably going to feel a little bit better about it. But from a process side, yeah, we'll typically oversubscribe 15-20%. Then I remember on Fort Davis Center, interesting case study. Speaking of the efficiencies, it was supposed to close on a Thursday. We got an email from Arvin on Tuesday. I think one of your investors wasn't able to fund or something. Someone backed out. There's a $200K gap, and so we sent an email out. And I think it was like 12 minutes. We had 200,000 investors. I think you guys brought in 100. We brought in another 100. But I mean, it can happen like that, right? That's the efficiency that we're talking about. The ability to tap this massive pool of capital instead of typically 50 to 200 or 300 investors. With an email, we can be up to 20,000 instantly. So it's a very it's a very different game. I mean, it's a total change from how we're used to doing it. But I think there's efficiencies in that funding and the ability to go out to a much broader pool of capital. We can have a pretty big impact on things like capital calls and the ability to close the deals.
Being in a CMBS workout advice space, I'm just somewhat interested. Speak up.
Yeah, try to speak up.
Yes.
So our mic can grab.
I'm interested in, are any of these deals securitized?
Yeah, the first is CMBS deal.
So how do you anticipate, down the road when some of these properties are not going great? How do you view the workout side of it? I'm thinking of ticks and how that played out. Obviously, many real estate cycles, and sometimes the deals obviously aren't working out the way that we hope they would.
Yeah,
Arvin, did you repeat the question?
Yeah, the question was if these deals go south, how will the workout scenario play out in the securitized world? So I don't think it's any different right now. The way that these deals have been done, it's no different than other real estate shops that aren't using crowdfunding, because the end investors are still the same individuals. I think it's just, again, the way that we're sourcing the investors is done online. So it's a little bit different. I think in the take workouts and some of the way that there was fractional ownership is a little different. Than this is still traditional GP LP. It's going to come to the sponsor, and I don't think it's going to be any different than the other typical CMBS or securitized deals out there.
Question for Adam. Have any of your fundings involved a capital call yet, or are they all still new deals?
Knock on wood, no. None of them have yet. And that's obviously when that comes down to building in a capital reserve. When you look at raising capital this way, you kind of have to anticipate this a little bit more. We haven't yet. Look.
Would you go back to if the capital call wasn't completed by the existing investors, could you go back to your platform?
Yeah, I think it has the ability to make the capital calls, as raise another tranche of equity basically through the crowd. We haven't had to do that yet, but I'm certainly sure that we could. Obviously, that would be up to Arvin, but yeah, I think that is a possibility for sure.
That would be a much more complicated story.
Yeah.
Yeah.
No,
Big educational component right there.
Question, Adam. Is there a consequence for somebody who commits to invest, but then ultimately doesn't bust?
No, right now. Oh, yeah, so the question was, is there a consequence for people that make commitments and then don't fund? In practice, I mean, I say we're probably 95, 98% completion rate. So it's not where we have people just throwing in a bunch of randoms and they don't ever follow through. Because of our process on the accreditation side, these people are very qualified. So it's not where you just click a couple buttons and then you can disappear. When you make a commitment, we have to take those steps to verify that these people are accredited. So they're taking those proactive steps to get a letter from their attorney or their CPA. They're taking steps and they're putting in effort as well. If they're not doing that, then we have to bug them and we have to get their K1s or their 1099s. We have to get their credit report. So it's a fairly engaged process that we do on the back end that I think kind of separates the wheat from the chaff. This brings the serious investors forward, people that are actually going to commit and follow through on their investments. So it's a pretty high completion rate.
Adam?
Two related aspects of it. Are there a lot of sites out there that are, you want to buy something, there's ratings and feedback of some type or the chat and all of that? So anticipate that will come to exist in this space, first off. And second off, as you look down the road, after there's a downturn, some of these investments don't do well, and so forth, what do you see as the ultimate shakeout in terms of acceptance of this on the part of investors after some milestone?
I guess the first is something I was going to bring up. I think that right now it's called the Wild West in this industry. There's really nobody that's acting on behalf of the investor from a diligence perspective. If you look at all the crowdfunding sites are incentivized to put as many deals up. Sponsors are incentivized to put deals up. A lot of these investors are new to the industry, didn't have access to private real estate deals before. So I don't know who's really policing it right now. So I think it's an interesting question that there's no rating agencies and regulation in the space yet. So who's a lot of investors are taking the returns on the website as thinking they might be guaranteed. And so I don't know. It's a question to Adam and scalability around a lot of these websites is who's really doing the diligence, who's actually digging into the sponsors' equity docs. Is there a covenant in there that somebody could miss that says that they don't have to, they could buy out their investors for 50 cents on a dollar, as they're trying to scale your site, who's really policing that. And I think that eventually there's going to be some fallout. There's going to be deals that don't go well, and I think that then regulation will come in. But right now, I don't think there's as much for rating agency or anything like that in space.
Adam, we can learn something from the syndication industry in the 80s, where a lot of those deals were highly levered. We had a downturn, a lot of them got wiped out, and the first thing the industry did to adapt was to come back and say, we're raising money with very little debt in the capital structure. So you want to minimize the probability of financial distress. That's a business decision you can make right up front. From the standpoint of the sponsors, that means you're going to raise a lot more equity, which may be great, depending on the efficiency with which you can raise it and the costs and everything else. So there are ways to deal with that the probability of financial distress occurring right up front. And capital structure was sort of the answer last time, and it's likely, in my opinion, to be the answer this time.
We're looking at a lot of the deals with a lot of interest from foreign investors. How do you deal with sort of Patriot Act sources of capital from overseas and sort of vetting that in compliance?
Well, so that's a key aspect for us. I mean that's a real concern of know your customer. I think that's where there's a lot of difference also between the full service and more tech platform items. Now I think that you can speak to this, but I think that OFAC checking and things like that, there's a lot of third-party services, so we expect that particular service will be provided or an option for additional speed. But there's also, suitability issues. There's a lot of things you have to think about with a retail investor that someone needs to do. And certain firms, I think, are built to do that. People who have traditionally dealt with high net worth individuals, they have a process in place. They know how to do this. They do it well. if someone like us, we're dealing traditionally with very large institutional investors, if you're doing the GE pension plan, well, your customer process is much different than some guy you met on the internet. So I think from some regulatory perspective, that you're going to see tech services that make this efficient, but there's also this big unknown as far as the SEC goes. And Adam mentioned the term reasonable steps. I think that's where the rubber hits the road as far as when these interpretations of these vague words come into play. Like when you see a bad deal happen, the SEC may very well come back and say, well, reasonable step. They have provided guides to that one. There's other terms like that that are terms of art and they do that on purpose. It gives them great flexibility to come back and say, well, we've actually meant this, and what were you doing what you did? And I think for larger firms, you'll see the waiting for the first few heads that pop up and get shot off, then you say, okay, that's where the line is. And that's where we're going to go better. And other firms, have a little more tolerance for risk and will take a different approach. But I think that's where we're going.
All right, I want to ask a question. So we talked about disruption, and in the real estate capital markets, disruption probably really means disintermediation. That means that there's going to be winners and losers in terms of who raises capital. Who do you think the losers are going to be? Is it the hedge funds? Is it the private equity funds? Who is going to get disintermediated out if you guys are very successful? David's very interested in this question.
Yeah. I don't know if it's going to be the traditional hedge funds and private equity shops that will. I think they'll figure out a way to get involved. And we're seeing that already. Again, as I said earlier, that's what's driving so much of this liquidity in the peer-to-peer lending space. They're almost probably 90% institutional now. So I think the institutional capital partners will find a way to get involved. And we're talking with them. I give you 5 guesses. You'll probably pick 3 of the top guys that we're talking about. So it's on everybody's radar. They see that this is coming. They see this is going to disrupt somehow their business. And they're just trying to figure out how they can get involved and make sure that they don't get cut out. To us, I think the biggest impact in disintermediation is going to be through that traditional broker-dealer channel. You look at the non-traded REITs as a case study. $20 billion raised in 2013. 14-15% load on a lot of those. That's a couple $1 billion of fees that's going to this middle market kind of broker-dealer intermediary channel. And I think that, at scale, once these platforms start getting that scale where some of these non-traded REITs can pull away from those captive broker-dealer relationships, I think that's where you're going to see a lot of disruption is through those kind of traditional capital raising platforms.
Excellent. Paul.
Sort of shifting away from the pure investment standpoint, I'm curious on how crowdfunding could be used as a gap financing tool in something like historic preservation or low-income housing or some other space where financing is needed but isn't regularly secured.
I think there have been some interesting, that Fundrise has done some interesting projects around really getting kind of the community together. So they've done some raises where, an old, could be an old dilapidated building in a neighborhood and trying to fund around advertising specifically and using the internet to advertise to investors that are specifically in the neighborhood. So I think that those type of projects are potentially getting done where you probably wouldn't be able to get traditional source of financing, so financing it through the crowd. So I think that it will play a role, and I think a lot of those. I think that that's one potential for where the industry is going is around trying to get the community to potentially invest. I know that they also did a project for JBG or I forgot who the developer was in DC. Was up against another developer to get the rights, and they crowdfunded a small piece.
This was MRP. Matt Robinson is one of our alums.
Yep, and they crowdfunded a very small piece with just getting all the local communities. So when they had the board meeting or the council meeting, they had a huge support group of people that may have invested a very small amount into that project. So it's being used in different ways in very interesting ways.
All right, it is about 9:20. I'm mindful of your time, Laura.
Have investors been able to separate the distinction between the developer and the platform, or after the funds have been raised, are they still basically calling the platform? for something that is now the role of the developer?
Yeah, so that gets into some of the different structures just as a very fundamental level in the platform. On Real Crowd, again, the investor they have the relationship with Arvin. Arvin uses our technology to communicate to those investors. So some of the other platforms, again, where you're not investing directly in the property, that crowdfunding platform is your point of contact, so you never actually get to deal with the actual operator who has the control and is making the decisions. You're dealing with that kind of intermediary as your go-between. So I think there's still some kind of unknowns or education that needs to be done around those separations. But that's again, a lot of our mission is trying to get education out and awareness that this how this actually works and what those differences are between the different scenarios.
I think it's pretty important for us to we've been trying to figure out which sites to align ourselves with. There's a lot of sites that are coming out, as Bonnie touched on, and some of them we think are putting up some questionable deals. And for the investors, they're investing with Atlas, but they're also investing with Real Crowd or Fundrise or whoever, or Realty Mogul. So if you see sites that are starting to put up questionable deals, we could be potentially associated, even though our deal might do well. 3 other deals that could have failed, we could just be associated with that. So I think that's pretty interesting. We'll see how the industry evolves, but I think we're pretty conscious about trying to align ourselves with the best in class crowdfunding.
All right, I've got David and then this gentleman. Speak up.
Is there a secondary market to provide liquidity for crowdfunded?
Not yet, but there's
Want to repeat the question, Bonnie?
he asked whether or not there's a secondary market. Not yet, but there are 2 platforms that have been in beta kind of coming out to provide that. One in particular that I've spoken with is Real Liquidity. And there are, and for other crowdfunding sites like Prosper and Lending Club, you actually can trade on a secondary market, but no one does. And I think that's more because those are shorter term loans. It's going to be more important for the commercial real estate space. But I think in the next 6 months, you will definitely see platforms popping up, just like you're seeing that David talked about, the OFAC and compliance and all that. You're seeing those pop up daily.
It's got a natural extension of where this all goes.
And I have a quick question for Bonnie. Is there anybody who's tracking all the deals throughout all the sites and actually the performance?
I don't think he. No. I think the only firm that I know of that tracks any type of metrics is Mass Solution. The metrics that I had was from a unpaid intern. And in terms of deal quality, no. And I think, as Adam kind of mentioned, once you start digging into the docs and the fees, and the deal that he talked about, I mean, it's all over the board. And the biggest risk to this industry and what's going to cause the shakeout is deal vetting by the platforms.
So, talk about the investors that have been investing in your deals. Are they local to the deal, or are you seeing them across country to invest?
Specifically to our deal, they've been across the country, across industries. For us, it's actually pretty important for us to get to know our investors. I think that a big risk is previously when we weren't using crowdfunding, we were investors with friends of friends of friends of friends of friends, and we got to know them. And so when it comes down to if something doesn't go right in the deal, at least we personally know they're not going to sue us for something crazy. And I think that we've taken the time to actually try and contact all our investors, but they're across the board, all different parts of the U.S.
Yeah, it's. I think that's one of the most interesting things on our end is seeing where these investments are coming from, and it's literally all across the board. We're in Palo Alto, so obviously there's a large tech component of it. We'll have one guy at Palantir, which is probably a company not many here have heard about, but they're worth $10 billion. And so one of their early employees found out about us somehow. They're just down the road from us. He invested, and then a couple of weeks later, there was 2 guys at Palantir investing. And now there's like 7 or 8 guys at Palantir investing. So it can run in those social networks. But then we've got traders on Wall Street. We've got people from the Midwest. We've got real estate professionals that see this as a way to get into the space. So it's a very broad cross section, and that's one of our goals is to help operators grow their investor network and manage that investor base. So it's definitely interesting to see. It's a very, very broad spectrum, kind of all across the board.
All right, I'm going to take.
Yeah, we gotta get over here.
Okay.
Yeah, just following up on that question.
Bernardo, speak up.
So, Bonnie was talking about that you have a potential pool of 8 million people domestically. Is there any penetration to international investors?
It's a huge opportunity. We've got probably 800 to 900 international investors on our platform. And I think, as you touched on it earlier, I mean, there's obviously a huge. We've been approached from groups in Dubai and the UK and China and Singapore and Japan and Brazil and everywhere to both replicate our platform there and also facilitate capital flow going back and forth. Right now, obviously, each individual operator makes that decision as to whether or not they're set up to take the international investors. What we've seen is some groups are, but they raise the minimum investment amount. So for them to go through that process on the back end, again, do the Patriot Act, the AML, all that good stuff, they'll be raising investment minimum up to $200,000 for international investors. But there's absolutely huge, I mean, obviously it goes without saying, there's huge interest in international coming into the U.S. real estate. And we're definitely working on some solutions behind the scenes to help ease that burden on the back end for sure.
All right, I'm going to take one more question, and then I'm going to encourage everyone to grab another cup of coffee. Our panelists are going to stick around so you can speak with them, and I'm going to go to this gentleman in the back.
So I'm an attorney. I do some private placement work, and I spend a lot of time with people who do not want their identities to be public or with the knowledge about their investments to be public. So how do you deal with that? Is there any way to keep the investor identity confidential?
So you're talking at the individual investor level?
Yes.
So yeah, it's not public. Arvin is the only one that knows on our website who's in his deals. So it's not where there's a public forum as to who's actually investing in the deals. So it is very private at the investor level. I think that was your question.
Yeah, I mean, I guess the whole idea of going through a separate third-party site and crowd, with the real crowd, are you obligated to keep confidentiality about who's coming over?
Yeah, absolutely. And so security is a very big issue for us. Our CTO is building Department of Defense certified secure software that they're using, Navy SEALs are using. So he's definitely we're building it from a secure platform. It's all bank grade encryption. It's all stored 3 layers dependent. So it's definitely security is a big issue. Confidentiality, obviously, again, Arvind, he knows who's investing in his deals, and that's it really.
All right. MIT, ULI, RIFA, all of our sponsors, we care a lot about education. And what I'd like to do is thank our 4 great educators for putting this panel on today. Great job. We encourage you to hang out and network and speak with our panelists, and thank you all very much for coming. We really appreciate it.